Okay, let's unpack this. We are diving deep into the Q2 fiscal year 2026 earnings call for DACT.
Right, the leader in those huge LED displays, the ones you see, well, everywhere, but especially dominating major sports venues.
And this deep dive is really for you if you love a good turnaround story.
Absolutely. The big question for DAC was, could this transformation narrative we've been hearing about finally translate into hard numbers, into real operating leverage?
Especially with some massive structural headwinds working against them.
And based on the results that dropped before the market opened on December 10th, the answer was a pretty resounding yes.
So our mission today is to cut through the noise. We want to figure out exactly how DAC's management pulled off one of the cleanest beats we've seen all season.
And that timing was key, wasn't it? The results came out early, giving everyone time to digest the numbers before the call even started.
Which turned the call itself into like a high conviction victory lap. It really solidified that it was a decisive beat on both sides. On profitability, diluted EPS came in at a remarkable 35 cents.
Which is just huge. That absolutely flew past the consensus estimate of 29 cents.
A 21% surprise. That tells you the cost controls are really, really working. A huge jump from 22 cents a year ago.
And the top line?
Just as strong. Net sales hit $229.3 million.
Sailing past the $217 million the street was looking for. That's a 5.4% beat, driving 10% year-over-year growth.
When you get a beat like that on both the top and bottom lines, it's just the clearest signal that the team is executing.
It's not a one-off. It points to a systemic improvement. And the market reaction was immediate, wasn't it?
Oh, yeah. Trading volume surged to, 3 or 4 times normal levels?
And we saw some really noteworthy options activity. Investors were basically voting with their wallets that this turnaround is the real deal.
Okay, so let's get into the bedrock of any good turnaround story. The margins.
This is where it gets really interesting. Operating income surged to $21.6 million. That's up nearly 37% year over year.
And that pushed the operating margin up to 9.4%.
A huge step up from 7.6% a year ago. And what's so critical is that they're now knocking on the door of their long-term target, which is that 10 to 12% range.
Gross margin held up too, right?
It did. Held firm at 27%. So they're showing real leverage. Sales are growing faster than costs.
But I want to dig into the how here. Management talked about value-based pricing and cost cuts, but the real story is what they did it in spite of.
This is the amazing part. The massive headwind was U.S. tariffs.
Okay, so how big was the impact?
It was, frankly, astonishing. In this quarter, they reported $8.8 million in tariff expense.
$8.8 million. And what was it, a year ago?
A year ago, it was only $1.5 million.
Wait, so you're telling me they had to absorb an extra, $7.3 million in pure unexpected cost? And they still expanded their operating margin to almost 9.5%.
That's the perfect way to put it. It's like a runner setting a personal best while carrying a 20-pound backpack.
So what would the margin have been without that?
If you strip that out, analyst estimates suggest their clean operating margin would have been closer to 13%.
Wow.
It just tells you the underlying business, the structural changes they've made, are running so far ahead of anyone's expectations.
That also brings up the net income number, right? 17.5 million reported, but there's some context needed.
There is. The prior year's number was a bit distorted because it included a big non-cash gain. If you adjust for that, making a true apples-to-apples comparison of core profit.
It was still up significantly.
Very significantly. Underlying profit was still up over 25% year over year. The execution story holds up no matter how you slice it.
Okay, speaking of health, let's pivot to the balance sheet.
And this is big news. They officially flipped to a strong net cash position, about $138 million.
That's $150 million in cash versus just $11.5 million in debt.
Exactly. That kind of cash generation gives them serious optionality.
So what does that mean for you, the investor? Does that cash just sit there?
It signals a shift in strategy from survival to growth. It's a buffer, sure, but it's also dry powder for M&A, for R&D, for more investment.
And they're already putting it to work, returning capital to shareholders.
Absolutely. They bought back almost 1 million shares in the first half of the year.
And the board just authorized more.
Another 20 million in repurchase capacity. That move, combined with the net cash, is management telling you they think their stock is undervalued.
So profits up, cash flowing.
Yeah.
But the market always looks forward. Let's talk about future revenue.
This is what really got the market excited. The visibility here is just massive. Orders grew 12% year over year to nearly 200 million.
And that's the third straight quarter of growth, so the momentum is real.
But the big number is the backlog.
Product backlog is now sitting at a record $320 million.
Up a staggering 36% year over year. That provides quarters and quarters of revenue visibility. It's gold in this business.
So where is all that demand coming from?
The key driver, without a doubt, is the live events segment.
The big stadium projects.
Exactly. They won projects at 6 professional stadiums in this quarter alone, 3 MLB and 3 MLS. They even mentioned they're 5 for 5 on major MLB projects this fiscal year.
That's incredible execution. But let me push back a bit. Isn't relying so much on these huge cyclical stadium projects a little risky?
That's the crucial challenge, and they seem to be aware of it. While live events is the big catalyst now, they are diversifying.
Where else are they seeing growth?
We saw strong growth in transportation, so think highway signs and airport displays, and internationally, they're landing some big projects in Middle East stadiums and European transport.
So the diversification's happening, just more slowly.
Right. Live events just happens to be on fire right now.
Okay, that record backlog is great, but we have to talk about converting it to actual revenue. There's a really important caveat for Q3, isn't there?
Yes, and this is where you need to manage expectations. About half that backlog is live events. These are complex projects, they take time.
And Q3 has a seasonal slowdown.
Exactly. The holidays mean fewer work days for installations, plus some of the biggest orders, like that massive Tennessee Titans project, won't really start converting to revenue until the spring.
So we should probably expect sequential revenue to be a bit soft in the next quarter, just because of timing.
That's the right way to think about it. It's a logistics and timing issue, not a demand issue. The huge revenue ramp from these stadium wins is really a Q4 and next fiscal year story.
Let's connect this to innovation. They talk about value-based pricing. What are they building that lets them charge more?
They're targeting the high end with new narrow pixel pitch offerings, or NPP.
This is for, like, corporate lobbies and control room?
Precisely. Places where visual quality is everything. NPP lets them compete on quality and command a premium, which flows right down to that margin expansion we were talking about.
And they're also getting serious about software and recurring revenue.
Yes, they're chasing that holy grail. They launched the Venus Control Suite Live. It's a cloud-based content management system for those big venues.
So it's a sticky software platform, not just a one-time hardware sale.
Exactly. It deepens the client relationship and creates a stream of high-margin subscription revenue. They're even trialing a broader SaaS product for their other customers.
Okay, let's talk strategic moves. The big one was the manufacturing footprint change.
Right, the new facility in Saltillo, Mexico, which should be running by late fiscal 26.
Is this a risk? Shifting production out of the U.S.?
Management was very clear on this. It's a strategic enhancement, not a migration. They stressed that about 80% of manufacturing is staying in the U.S.
So the Mexico plant is more about agility and risk mitigation.
It's an insurance policy. It helps them serve Latin America and gives them optionality against future tariff issues. It's not about relocating jobs. It's about enabling growth.
And they're also modernizing their internal systems, right? The back office stuff.
Yes, the digital transformation. A new ERP system, a better quoting platform, even AI tools for customer service. Each of those things shaves off a little bit of friction and lowers long-term costs.
And finally, let's touch on the leadership change.
A really important piece for stability. They've appointed Ramesh Jayaraman as the new president and CEO starting February 1st.
His background is in global tech and industrial, places like Bosch and Harman.
The board called him a transformational leader, which seems to fit the playbook they're running right now perfectly. He's in a look, listen, and learn mode until he officially takes over.
It seems like a very smooth, deliberate transition.
It is. It signals stability, which is exactly what the market wants to see when a company's execution is this strong.
So, boiling it all down, what does this mean for you, the investor, looking at this turnaround?
I mean, this deep dive confirms it. The turnaround story is now a turnaround reality backed by hard financials. DAC is evolving from a cyclical manufacturer into a more resilient solutions platform.
And the market has been rewarding that. The stock is up over 70% in the last year, right?
Yeah.
Crushing the S&P.
And these results basically justify that move. The story is now built on real pillars. That massive backlog, proven operating leverage, and a rock-solid net cash position.
So what are the key dates? What should we be watching for on the catalyst map?
3 big ones. First, the official CEO transition in early February. Second, and this is the big one, an investor day planned for early April.
That'll be the new CEO's chance to lay out his vision.
Exactly, and to give more color on that 10 to 12% margin target. And third, just watch for news on the installation of those big MLB projects through the spring.
Okay, we have to transition here with our very strong disclaimer. This is not financial advice.
Absolutely not. We are analyzing public information from the earnings call. You must do your own due diligence.
But with that said, if we were going to sketch out an outrageous but plausible trade idea,
we would try to capitalize on that short-term seasonal dip versus the very clear long-term strength.
I love this. Explain the thesis.
The thesis is that Q3 revenue might look a little soft sequentially because of the holiday slowdown and project timing. Some investors might get spooked by that.
Even though the 36% backlog growth is still there?
Exactly. The long-term story is fully intact.
Yeah.
So you have a short-term window of potential volatility before the strength shows up again in the spring.
So how would you structure a trade around that idea?
You could implement a structured trade, something like selling put spreads that expire in March, which is a bet that the stock won't crash during that seasonal weakness. You collect premium from the uncertainty.
And then you use that to fund the upside bet.
You could. And at the same time, you'd buy call options that expire further out, say, in May.
Which would capture the potential positive reaction from the April Investor Day and the revenue ramp from the stadium projects.
Exactly. It's a bet on the long-term strategic execution overpowering the short-term seasonal noise.
A very clear bet on the structural improvements we've just outlined.
Right.
That brings us to our final thought, the key takeaways. DAC is showing incredible operating leverage, navigating huge tariff headwinds, and has built massive visibility with that record backlog.
So we'll leave you with this provocative thought to mull over. Given that management has now flipped to net cash, is actively buying back stock, and is investing in growth with the New Mexico plant, does this major shift in capital allocation signal that the turnaround phase is officially over and the sustainable growth phase has begun?
And does that make their ambitious 10 to 12% margin target a near-term certainty rather than just a long-term goal?